Hello everyone. Welcome to today's session. Today I'll be joined with Jack and Jean-Charles for today's webinar. Jack, I'll let you the floor to start.
Thank you. Good afternoon, good morning for some of you. We will start today with our webinar on the oil and gas project. Let's start directly with the agenda of today. The agenda seems a bit small, but we have a lot to say within this hour together. The most important part I would say is that if you have any questions at any time, don't hesitate to ask them in the chat. We will have a bit of time at the end to answer all of them during a Q&A session. Don't hesitate to ask them at any time. Don't bother, I would say, sending your AI chatbot. We will keep this meeting in between humans. So if we see some chatbots getting connected, we will kick them out of the meeting. One word regarding, let's say, our company and the evolution of the company. Jean-Charles, who joined us today, created To Be First Consulting almost 15 years ago based on his experience and success that he had within ABB as VP for oil and gas. So again, if you have any question, if you want to pick his brain, go for it in the Q&A session. He'd be more than happy to answer all your questions. Then the company evolved with Jean coming from Siemens. Basically, we extended our footprint to be more accurate and be more precise on the, let's say, energy process industry. But I'll leave Jean explaining exactly what is our scope.
Yeah, normally, thank you, Jack. You already know all of us, but just as a reminder, we are still the same. We still have the same approach to the market, meaning that we combine three pillars. One is the database, Project Smart Explorer, that all our extract today will be based on, where we trace all the project since 15 years almost now. But we combine data with the expertise. That's a little bit what we are going to do today. Because it's great to have data, but to transform data into information, you need to have some clues on how to read those information. And we have a third pillar, which is, of course, a big networking I would say exercise where we like to put people in touch so they can work together, they can exchange. So again, our company is all around those three pillars. And if you have questions about it, we can also address them at the end. The scope of the project today, we are only going to focus on oil and gas because that's really the main topic we wanted to address with all of you. But as you may remember, we address all of the other projects as well inside the database. Everything which is energy, which is process, of course, it's always part of the database. One quick news before we start really with the core of the webinar is that we are launching the new version of Project Smart Explorer in just 2 weeks. Okay, a little bit more than that. So it will be a new design, a new code, new functionalities, of course, some AI also to be in the trend, but mostly to help you connect our data with your IT ecosystem. And honestly, the spirit is exactly the same, so we keep it simple. It's just that we want to create more value from the data and more usage, so that's why we are pushing a new version. And if you are coming to EDIPEC next week, we'll be pleased to demonstrate this new version in our booth in the French pavilion. So you're free to pass by, and you can give us also inputs and some functionalities that we may not have things first, but you'll be more pleased to have later on. No, Jack, I give you the floor for the future of oil and gas.
Yeah, looking forward this new version of Project Smart Explorer. But let's start with the future of oil and gas. When we talk about oil and gas, if you want, for example, let's take the example of an FPSO. If you want to have an FPSO, the main question that you have, or you should have, actually the operators have, is will there be a demand for my product in the next 10, 20, 30, 50 years? And that's more important than wondering about let's say the spot barrel price. And if we look here on the graph, we have two graphs. We have on the left the demand for oil and the demand for gas. Let's start with the oil demand. If in blue, we have the demand made by especially the International Energy Agency. Today, we run at around 103 million barrels per day of consumption. And every, let's say, serious scenario based on demand and demographics is pushing these limits around of a growth of 15% until 2050. we put you in the graph also to, let's say, pessimist and realistic scenario in gray and in black. These are basically the scenarios when you take into consideration the, let's say, political factors. In black, I think it's the scenario of the Paris Agreement signed in 2015. This scenario has been wrong since day one, so most likely it will never happen. The demand for oil will still grow, and the demand for gas will grow even, I would say, stronger than that, because for gas, if you look at the numbers, we are not talking about a growth of 15%, but 50% in the same time range. Currently, we are at 400 billion cubic feet per day. And in 2050, scenarios push us to 600 billion cubic feet per day, with some, let's say, a difference from one region to another, obviously, but globally, the demand is growing. And when you have a demand like that growing, first you need to invest a lot to just compensate, let's say, the current production, compensate the depleting field, and to, let's say, also catch for this growth. Jean will come and explain in two minutes what are, let's say, the drivers behind this growth. But before that, let's answer a simple question, which is, do we have, let's say, the product under the ground to answer this demand? Short answer is yes. You have on the left the evolution, let's say, of the discovery that we made of oil reserve throughout the years, and it's going up year on year. Currently, we are aware of 1,850 billion barrels of oil. So what does this volume means? If we transfer that, I would say, in years of consumption, if you look at oil, just with the oil reserve that we know today, we can sustain current level of production for 50 years, taking into consideration a certain profitability of oil, okay? Meaning a barrel at $75. So if you look at a barrel of $75, we can live for 50 years with the current oil reserve. I know that currently the barrel is a bit lower than that for different reasons that I'm not going to explain today. If you look at gas, the range is in between 200 and 300 years. So way enough, we'll make an update. Maybe the next generation of Guillaume will make an update on gas reserve. But we have enough resources in front of us. You need to put on top of that, let's say, the evolution. First, discoveries. We'll still make more discoveries. There are still some fields that needs to be discovered, number one. And second is also the evolution from, let's say, a technical point of view in terms of exploitation that is happening. For those who worked when my father was working at that time, when we were extracting 30% of an oil feed, we were really happy. Today, we are closer to 60, sometimes 70%. And in the future, most probably this number will grow. Meaning that oil and gas production will not stop because we don't have oil and gas anymore. Now, as I said, maybe you can explain what is driving this growth of demand. Yeah.
No, thank you, Jack. And I mean, the main message from that was, okay, oil and gas demand is up, and it's up, I would say on the long term. And sometimes, especially like us, if you are sitting in Europe, this message might be a little bit confusing compared to what you are used to read in the news. But the problem that if we investigate and if we look in the figures, the drivers for oil and gas are many. Here we make a kind of picking three examples of growth that we see from going in oil and gas. And the first one is petrochem. Currently, we are experiencing kind of a reorganization of the market of petrochem, mostly around assets and demand, and also because China is arriving to maturity. But if you look on the long term, the petrochem demand is going to double from today to 2050 again. It's quite a lot, to the point that it will wait in 2050 about 17 million barrels per day, so quite a lot of barrel, and that's just for the plastic part. If you add all the application of petrochem, meaning fertilizers and all, I would say, the variation that you can find around naphtha, etc., here you are closer to 40 million million barrels per day equivalent in 2050. So of course it's quite a lot. It's a huge volume of oil and gas that will go to petrochem, and having in mind, I would say, energy transition, here it doesn't work because you can produce a lot of green electricity. It doesn't produce plastic. It doesn't produce petrochem, and that's why also in the long run we see petrochem, of course, growing the demand of oil and gas, but it's also I would say longer than 2050 because there is kind of an impossibility to replace petrochem with something else than oil and gas. So that's really one of the biggest drivers that we see today. The second driver, which is really, I would say, a little bit hidden, but driving also oil and gas, is power gen. Of course, renewable is going up, and that's what you see on the second graph on the left. The yellow part is the solar forecast, and solar is rising quite well. Windmill is more tricky, I would say, which is good. Okay, by the way, this jump in renewable is great, but the problem that today renewable is not able to absorb the entire growth of electricity demand. So of course it means that it's absorbing part of it, and the rest needs to be absorbed by oil and gas, because the game today is to reduce a little bit the coil, which is still growing, by the way. And of course that's why it also gives perspective to oil and gas, and mostly gas, to be honest, to grow just to produce electricity, because the demand for electricity, and even more today when we start to see arriving electrical cars, more electrification on industry, and also artificial intelligence, you understand that there is a boom in electricity, and renewable needs to be helped by gas application to power this electricity. A third segment, which is also growing the demand for oil and gas, is jet fuel. Okay, we are back to record level. Okay, after COVID, it was going down a little bit, but now we catch up and we overpassed those records of before COVID. And to give you an idea, today it's weighting about 9 million barrels per day that we use for jet fuel, and in 2050 it will be the double. Okay, so again, you can imagine how much it represents and how much is driving the demand of oil and gas to the roof. So just from those subsegments, I would say, of oil and gas usage, and you see that the oil and gas is going up. But if we take it from the other side, meaning that we look at oil and gas among all the energy, and if we look at the total volume of energy demand, it's also going up. And it's going up quite fantastically, to be honest, because from today to 2050, it will grow up by 25%, the total demand of energy. It's mostly due to, I would say, developing countries in Asia Pacific, where the standard of life of people are growing, and of course it grows the demand of energy associated to those population. There is also a growth of demand, especially in electricity, because of new usage, as I said, the cars, artificial intelligence, data centers, etc. So combined, you have a demand for energy which is going up by 25%. And the problem that when you have this growth of 25%, we have identified, and everybody has identified at that point, that renewable, even though it rises, it doesn't match this demand. Okay, so there is a total demand which is growing bigger than renewable, and that's why we need more oil and gas to compensate, I would say, the growth that is not being absorbed by renewable. And that's why, and if you come to our webinars or to our workshop, you may have heard us say it quite often, that today we are not so much into an energy transition, meaning that there is no replacement of oil and gas application by renewable. What we are experiencing right now, and we should experience for many years, is an energy addition, meaning that renewable is doing its own life developing, which is great, but in the meantime we need so much more energy that we still need to develop the oil and gas. Okay, and that's what we see also in the figures that Jack is going to present in the next part.
Thanks, Jean. Let's jump into the project outlook. And first, let's say the forecast. It's not the exact opposite of what we just said. The oil and gas is not disappearing after 2029. Here, the graph is reflecting the project that we have in the database. Okay, so the projects of 2030, well, they have not been announced yet. But if we look at the curve of the evolution, let's say basically since COVID, you see a significant growth year on year, and this is explained by several factors. First, you have quite a high level of investment that is required anyway to maintain the current production. Then you have the second layers that Jean explained. There is a boom, let's say, in electricity demand, so you need more projects to answer this demand. There is the need to have more petrochem product. So here again, it creates another wave of projects. You have also a wave, let's say, what we call projects for, let's say, energy security. One of the best examples is the consequences of the war between Ukraine and Russia, where you need to reorganize basically all the flow of mainly of gas between Europe and the rest of the world. So here also it creates a wave of investment. Now that's what the market wants. The question is that what the market has? And the answer is no. Unfortunately, the demand is not matched. It's growing. For those who were with us last year, we warned you that probably 2024 was somewhere close to, let's say, glass ceiling of what the supply chain could deliver. And today, we are almost at the end of 2025. It seems that it's hard to go further than that. Okay. The consequences of that is a huge backlog. Okay. The projects are not being canceled. They are just postponed. So already, I mean, we still have 2 months to go in 2025. And if you look at already the backlog of 2026, it's around 60% of what the supply chain can deliver. And if you are looking for an FPSO, most probably if you're getting awarded today, they will start to work in maybe in 2027 at best. Also keep that in mind because Jean will explain what are the consequences from the engineering point of view, and this graph is important. One last thing, here we are only showing oil and gas, but keep in mind that the same supply chain, so the same engineering, the same manufacturers are also doing petrochemicals, are also doing energy transition, meaning that if you put on top of all these layers the decarbonation and all the petrochem activity, you have to demand that is so high that the supply chain is still the same, just can't follow. Now let's look where the projects are, I would say, from a geographical point of view.
No, you're right, Jack. I mean, the moment and the momentum, the dynamic we see is that oil and gas is going up, but all the other energies and other projects are also going up. So that's why, I mean, even though the forecast is high, what has been awarded goes to the backlog because there is just not enough capacity. In terms of geography, what is quite clear is that we have big energy hubs around the planet. I would say mostly historical production sites like Middle East and the North Sea, which are still quite active, to be honest. And you see our map in the region of Middle East. I mean, there are so many dots that you can't even see the countries. But you have also, and since the last 10 years, a shale hub which has been developed around US or around the Permian Basin, which is of course quite dynamic, and you will see in the figures. And we have no offshore hubs which are being developed around Brazil, Suriname, Guyana, around the Guinea Gulf, for example, and also around all the Southeast Asia region. And I mean, if you cover just those cycles, you cover 80% of the market today. So it's quite important to have in mind that when you are discussing market and region, those are the places you need to have in mind. If we look in the figures, what is quite clear, you see the graph on the right. The first one on the top is the location of the project. In the middle is the location of the feed, and at the bottom is the location of the EPCs. And of course, if we go from the top in terms of location of project, you see that US and I would say North America in dark blue represent about 35% of the business. It's 18% of the project, but it's double the percentage in terms of capex. So to give you a little bit the range, and here we see a huge tsunami of projects fueled by, of course, LNG and Trump arriving in office and opening the valve, I would say, for all those projects to happen, especially on oil and gas. What is quite interesting is to see that behind, Africa is now getting a huge market share on those markets, while you see Middle East is a bit shy. To be honest, Middle East is a bit shy. Why? Because on the last 2-3 years, if you are looking at projects like Amiral in Saudi Arabia or projects like QFE in Qatar, those ones were so big that today, of course, they need to concentrate on those projects before going to giant, I would say, investment again. But Africa is back, mostly back because everything which was supposed to happen in Russia and is happening today in Russia needs to be replaced by big volume, and that's why it goes back to Africa. In terms of feed, you see that half of the feed are now done from US, of course, because US does a lot of projects for itself, I would say, but Houston is really becoming quite of the headquarter for all the feed of oil and gas, then followed by Europe, and then a little bit of Asia Pacific. The curve or the chart is more or less the same for the EPC. The only difference is that Middle East is gaining more momentum. Why? For the simple reason that today, for in-country value, most of the project that needs to be done in Middle East, the EPCs has to be done for, I would say, local content in Middle East as well. So that's, I would say, the main shift that we can see on the market. And what is really interesting is that if you take those graphs, but you look it onto, I would say, a specific period of time, okay, because the evolution are quite massive. You have, I would say, 4 periods here. You have one before COVID, where I would say, of course, the domination was mostly US under Trump administration already, and Middle East, and then Asia. And you see that Europe was still waiting a little bit at that time. And you see that during 2022, when I would say all the people or many people were thinking that oil and gas was kind of disappearing, you see that the balance was quite different because Asian countries were ballistic on those projects because for standard of life purpose, they needed those projects to happen while US was a bit short. And then you see the picture that we have today in 2025, where US is of course massive due to Trump, Africa is quite big as well, and Middle East is still claiming a big part. And then you have the forecast for the period 2026-2028, where US remain quite the biggest player. Africa is taking and remaining in this market share, while you see from the previous period, Africa was more or less non-existent. To note that, of course, Africa, you still have this effect of a lot of projects being announced and a little bit less being executed. But even though you consider that half the project will move on time, it's still a massive part of the market, which is now happening in the region. And what is quite surprising is to see Middle East, which is, I would say, in the forecast, so small for the next 2 years. To take into account that here we are talking about oil and gas, and today a lot of countries in Middle East try to have a really big push in strategy into petrochem as well. You see also from, I would say, the bullet points, the number of projects and the capex evolution. So even though the number of projects is quite, I would say, stable, the capex is growing quite massively due to complexity of projects which are going up, but also due to the fact of inflation as well. Going to the operators, Jack, I'll let you to make the presentation.
Yes, let's look with the first helicopter view on the let's say different families of operators. So the first one, which is the red part of this graph, are the NOCs, so the National Oil Company, that are taking basically 43% of the market. Over the decades, their role majorly changed, and now they are no longer, let's say, local structures, local financial structure. They can do projects on their own, and they can even go, I would say, abroad. Second player in green are the independent. And these independent, we find them especially in LNG application and in midstream application, which is currently having, let's say, a big push on this application. So that's why their share is that high, knowing to say that these independents are mainly American companies. And finally, we have in blue, with a bit more than 20% of the market share, the IOCs, so the international company, the 6 super major that we know. And we still find them, let's say, in the most complex from a technical point of view, and also with the highest capex requirement, all these projects that are quite technical and quite complex. Here we find them. One care point doesn't mean that they are only on these projects. Now they are also more and more in joint venture in some projects. And if you take actually in consideration the joint venture, basically their footprint double in number of projects and in number of investment. It doubles via the joint venture. So that's one care point. If we look now more into the details on the ranking of this all of these operators that we made on the next slide, we find, I would say, the same actors. Okay, the same historical actors. You see that the first two are Total and BP, which made the most investment. This is oil and gas. I would say it's not where their marketing communication budget is going, but actually their total investment is going there in oil and gas. And then you have a lot, one care point also, you have a lot of independent here on the chart. Number 4 is one of them. They are not small anymore. Some of them are quite big. And some also actors in this chart are benefiting from, let's say, huge project. It's the case of the 3 that we mentioned, like YPF, AGDC, and NPC. So be careful with this, let's say, operators that have only one project. It can trigger the result. One point before moving to the engineering details on ADNOC and Aramco. I assume that most of you will go to ADIPEC next week, and you can see on this chart, Saudi Aramco and ADNOC are not on the chart. We did not forget them. It's let's say, explainable. If you look at ADNOC, first, I think they are in 15 projects in oil and gas with a total of 45 billion US dollar. So they should be on the graph. The thing is that they have several entities. So you should sum up all the entities of ADNOC, ADCO, ZADCO, Gasco, and so on and so on. For Saudi Aramco, I joined what Jean mentioned before, with the Amiral Satop being awarded. They concentrate now more their effort on the execution and more also on petrochemical activities, which is not reflected in this ranking, especially to protect their Asian market. That's not a topic for today. That's something that we already explained. But keep that in mind. We did not forget them. They are still there somewhere in our minds. Anyway, with Project Smart Explorer, you can extract all the projects of Saudi Aramco and ADNOC before going to ADIPEC.
Definitely, definitely. So now let's do the same exercise, but I would say from the engineering companies. What is quite interesting with the engineering company is that clearly they took over the leadership of our industry for many years, and not to say decades. The leadership was really into the hand of the operators. Okay, operators were deciding, were giving the pace for project, etc. And now we think that the leadership went into those engineering companies because what is quite interesting, and here, for example, is the example of Saipem, where the backlog of Saipem grew up by 50% in the last 3 years. And to the point that, okay, 50% is quite massive when you think about it, knowing that it was quite stable for many years, and that today the backlog of Saipem represents more than 2 years of revenue from the company. Meaning that if you get awarded a project as of Saipem today, okay, they will start working on it at the end of 2027. Okay, so you can imagine that there is a little delay when those guys apply to project. And in fact, the situation is quite clear. There is more project on the market because there is more project in oil and gas, but also in other, I would say, energy transition, in petrochem, etc. And those projects are becoming more complex. So engineering are kind of the cornerstone into it and have become now the bottleneck because there is more operators, there is a little bit more suppliers, but not that many, but the number of engineering companies is exactly the same. So today, honestly, when you are an operator, you select the EPC and the engineering company you can to execute your project, the one that have space for you and the one that are happy to work with you. And from the engineering point of view, also today, they are more interested by executing project than spending a lot of time and resources to bid on EPC contract, as they are not sure to win. And engineering companies over the span of the last 3 years have adapted to this increasing demand of project. That's why we see this new business model that for the people who attend our meeting are used to, they convert more and more FEED contract to EPC contract. Okay, so there is no more EPC bid, and it's the same company doing the FEED and the EPC contract. They know it's a majority of the market, but they also start to sell in advance kind of engineering hours, and you start to see those deals here we listed, for example, the deal between ExxonMobil and SBM, but you have the same thing with Aramco and Wood and BP or KBR, where you have those operators that book, for example, Aramco booked 1 million hours of engineering into wood capacity in Middle East to be sure that Aramco can deliver the project on time and that the book and have the bandwidth of engineering to do it. From the engineering point of view, of course, it's a good way to make more money because you have better usage of your resources. And that's why also we see them internally putting in place strategy to streamline their execution to try to save time, because for them saving times mean they are going to save a lot of money. And we have many examples of operators that have no choice than to follow, I would say, this dynamic. One of the latest examples is Total and Energy and SBM, for example, where they agreed on a standardized design for an FPSO in Suriname, which is quite new, I would say, to a lot of companies, especially maybe Total. If you look at the ranking now of those companies, here we made the ranking of companies which have won the FEED and are currently working on FEEDs. The column CapEx here is a bit misleading. That does not represent their backlog as a company, as an engineering company. It represents the total capex of the project where they are currently doing the feed and where they will do the feed next year or the following one is already awarded. And what is quite clear is that those companies are just underwater, they're already full. Okay, you take Technip, the leader here, it's representing and weighting more than almost twice the second one. You understand that if they have to execute 120 almost billions of projects, it will take them some time, definitely. And on this ranking, what is quite clear also is that in oil and gas, the Western engineering companies are still dominating the market by a lot of length, as Jack likes to say. But honestly, you don't see Chinese there. Okay, so oil and gas is still way, I would say, highly protected from, I would say, cheap engineering, because if you make the ranking, you see that it mostly belongs to those people. Then you have also kind of the market, which is helping some companies benefiting from the situation, because the companies which are quite good around LNG, like Black & Veatch, Kiewit, or CBNI, of course, are getting more backlog and more feed because the market is calling for more LNG. Here we give you the ranking for the feed. Honestly, if we do the EPC, it's more or less the same. Mostly because right now we have this effect of feed being converted into EPC to the same company. So of course, the more you have feed, more you can transform into execution at the EPC stage. And you can imagine that this picture of, I would say, CapEx for those companies will be the picture for tomorrow of those companies at execution. Okay, so it's quite important to have in mind as well.
Thank you, Jean. Let's look now at the evolution. First, let's look at the application, and Jean will explain some design evolution that we noticed on the market. But if we look at two applications that we put a spotlight on, the first one is offshore projects, and the second one is LNG. Let's start with the offshore projects. You see that it's going up, and it's going up for various reasons. Number one, well, if it's not offshore, it's onshore. And currently, all the onshore fields, I would say, are already in production. And if they are not in production, they can't be so far for various reasons. It could be the case of Venezuela, or it can be the European shale gas, shale oil. Currently, these projects have no chance to happen in the near future. So the next option is offshore projects. And with offshore, it's particularly floating units, so FPSOs, that is driving the market up because, well, the last, I would say, innovation in FPSO make the projects more profitable also. It's easier to handle. And we need also to keep in mind that for some region of the world, let's say it's less risky to be a few hundred miles off the coast than inside the country. That's a reality that we need to take into consideration. Second application that we took is the LNG. LNG is going up. It has been going up by wave historically. You can see them in the graph. First wave was in 2015, then one followed in 2018. And since I would say 2024, which is the consequences of decision taken in 2022 and 2023, since 2024, it's closer to tsunami than wave. Okay, and it's clearly driven by the demand that we saw on the first slide, the demand of gas. So currently, I would say every cubic feet of gas is appreciated. So the more projects, the more LNG is happening. For those who are working in LNG, you know that today is a golden age. And most probably, this golden age will last when you look at the demand of gas that is happening in the next years. We made, let's say, ranking of this application by CapEx, which is the next slide. And here, well, without a surprise, you have LNG train, which is by far the biggest application. LNG train concentrate 42% of all the oil and gas investment. Okay, then followed, and then it's following the FPSO and the FLNG. Just to put some magnitude between LNG train, we are talking of a pool of 50 projects only, which are gathering almost 500 billion US dollar of investment. So it's tremendous. And then, as we explained, FPSO, FLNG are following this podium for the reason that we mentioned. It's financially less risky, and also when you take into consideration the decommissioning of, let's say, a classic platform, well, you have less trouble with an FPSO than with a classic platform. So that's why these reasons currently have the favorite in terms of engineering design. Talking about the design now, if you want to have a specific look at some designs before moving to the conclusion, and then we will have some time for the Q&A session. So you can go already on for the question if you like.
For sure. In fact, I mean, we see an evolution in terms of type of plant, but inside those type of plant, we also see an evolution in the design and in the interest. Part of the evolution is coming from, I would say, a need of, I would say, some virtuosity, because we see first a lot of electrification. This electrification here on the left on the chart, we map you the same electrical package in oil and gas project along the years. And you see that, of course, the oil and gas market is growing, as we explained earlier, but inside this growing market, the electrical package is growing even faster, to be honest. And here behind, there is three reasons which are quite important. First, there is more electrical application. The usage of electricity is more, and of course it's second-ended by trying to have more digitalization, to have more digital twin, to have more instrumentation, more data, more automation. So all overall, inside the project, the usage of electricity is more. And then there is also an electrification, I would say, from the design of project. Jack was mentioning LNG. Of course, today there is more and more project where the compressors is e-train, so electrical driven train compressor, then I would say a gas turbine driving a compressor. So this usage is clearly a big trend. Honestly, today we have a majority of energy projects, just to give this example, which are going to be driven by electrical motors inside the database. So you can imagine how much it impacts the design, because of course the compressors are smaller, but you have more compressors. So of course the design of the project is completely different. Behind electrification, I would say the same, I would say, targets, let's say, reasoning to reduce the carbon footprint calls for a lot of decarbonation. And inside those decarbonation, a few years ago, we added inside the database, this label called low carbon for all the projects where we know they will try to reduce to the maximum the carbon footprint of the project. And today, honestly, when it started, it was only a few projects, but today this low carbon aspect weighs about 10% of the entire oil and gas market. So even though people and operators are going to produce oil and gas, they try to do it with a lower carbon footprint than what they are used to do in the past, which is quite interesting because, again, it changed a little bit the design of the project. It's quite also accurate with LNG project. Why? Because LNG, as you have gas and you can have emission of natural gas, and the carbon footprint of natural gas is 25 worse than the carbon footprint of CO2. So regulation is really strict around the LNG. It's strict in Europe, but it's strict all over the planet, because usually the bank that are going to finance those energy projects don't want to have a huge carbon footprint into their assets, because even though Trump election is passing by, in 2050, when everybody will need to be net zero, those projects will still be in your balance sheet and Trump will not be in office anymore. So at some point, you still need to have some clean oil and gas, and that's where the decarbonization comes with four main solutions. First, electrification, the point we already discussed, then a lot of carbon capture, and trying to capture not only the carbon, but for example, natural gas and reinject it on the ground, like a project Venus in Namibia from Total. But then they're also looking at energy efficiency, trying to save as much as energy as possible, and also use digitalization, trying to modelize what should be the best configuration of project to be sure that we reduce to the maximum, again, the carbon footprint. So here, those two aspects are really pushing the design of project. And to be fully transparent with you, you know that we do a lot of modeling behind the project to evaluate all your product line. And honestly, every year we change quite a lot our models because the design of project are really changing a lot currently. The second point, which is also changing the design, is that engineering are underwater. And to save time and to execute more projects, they are going to push more and more for modularization and standardization. Here I put the example of SBM fast forward. So I put the little R because it's I think it's registered. But SBM, it was really the answer for the giant demand of FPSO they had. Today SBM they have 4 years of backlog, which is quite a lot to be honest. And of course they would like to do more in the same time. So for them, one of the answer to that problematic was to standardize project design and also execution. Okay, because of course standardizing the design is one thing, but to put it in execution is also another point. And honestly, operators have to follow. I was giving the example of Total Energy in Suriname, but that's one of the key examples where Total, even though there might not be the perfect fit to have this FPSO in Suriname, it was better to have these standardized FPSOs than to have no FPSO. So they were happy to sign it and follow SBM in that direction. And modularization, if you remember, we have a lot of black belt of experts of this industry. Originally, modularization was only about offshore project because it was easier to build all the modules on the ground and then assemble those modules offshore. But today, those modules, they also apply LNG project to many refineries because it gives you the opportunity to save time by building in parallel different units. And of course, if you look at it from engineering point of view, having those modules give you less to manage because you don't have to deal with all the people of the supply chain. You allocate those modules to integrators or to OEMs, and then they are the one responsible for it. So you manage less entities. Okay. It also reduces the logistic and on-site construction because you welcome all your modules and you're going to assemble onshore also, not only for oil and gas offshore application. The second point, which is a little bit in the same direction, is standardization. Standardization, we see it at different level. We were used to see it, I would say, at the level of some operators, and you have companies like ExxonMobil, Chevron, and others, which have developed a full catalog of process units that they know. Say, okay, if we need hydrogen, we're going to put this unit. If we need this amount, we'll put 2 units, etc. But now we start to see standardization arriving to different level of the supply chain, meaning at the component level, at the system level as well. And we see, for example, some key OEMs of compressors, not to name them, of transformers, not to name them, or of cables, of power cables as well, where the guys, they say, okay, we have a backlog of orders which is completely crazy. So if we want to deliver and maximize our value, we need to standardize. And then it's take it or leave it. So it's really a bargaining game between operators, engineering companies, and the first layers of the supply chain to say, okay, if you want to have your project on time, you take this and you will adapt. It's the only problem that usually when you start to standardize the component, it means that you need to tailor-make the design. And of course, if you want to standardize the design, then you most of the time you need to readapt, I would say, the pieces of equipment. So there's a little clash here going on. But in the meantime, even though you standardize only one layer, I would say, you still save time in the supply chain because either you save time of design or you save time of documentation or you save time of production. So both I would say modularization and standardization are set to grow. That's really, I would say, the way the industry is going to cope with that situation. And of course, you need also to push yourself in that dynamic because you can really benefit from this situation. arriving to a conclusion, and you see we're targeting 45 minutes, so we are perfectly on time. The main point that you need to remember, if there is only 6 points that you need to remember from this meeting, and then we'll go to the question, and you can even question us next week in DPEG, is that first, despite energy transition taking up, the long-term oil and gas demand is going up. Okay, it's quite independent, and honestly, the entire energy world is growing so fast today that we need any type of energy, and oil and gas being one of the biggest stream, of course, of energy. And if you have oil and gas demand, you can be sure that there will be operators to launch projects to answer that demand. Okay, it's quite simple, because if there is a demand, there is a space to produce it. And the result of that situation and the long-term perspective of that situation is that there is a boom in oil and gas project, especially in LNG and in offshore, as Jack mentioned, because that's really the two stream of, I would say, demand and opportunity that we see on the market. And no, I would say the result is good from the operator level, but then it goes on to the supply chain, and that's a problem, because inside the supply chain has not grown that much compared to the volume of project. And now the challenge is to say, oh, this supply chain is going to absorb this backlog. And the way I would say the first layer of the supply chain, so the engineering companies are doing it, that they absorb those increasing demand by having those new business models. So trying to, I would say, transfer fee contract to EPC contract to execute at DPC and not to restart doing some engineering, but also by adapting new designs, so standardization, modularization, etc., and anything they can do to deliver more projects. Because as an engineering company, you make more money by delivering more projects than spending more time in one project, definitely. So no, even though you are not directly yourself in engineering, of course it opens you the door of many opportunities, because it means that the engineering will remain, I would say, underwater and full throttle for many years coming because of oil and gas. So it calls for more service and more support from the supply chain to those engineering companies, trying to get the project to go faster, for the documentation to go faster, etc., etc. And here, that's what we see, I would say, on the first layers of the suppliers. But that's something also we start to see going down inside the supply chain, where because of the demand being too fast, or too big, sorry, project need to go faster to be executed, to match with the demand. And of course, it calls for more expertise to be done, more than, I would say, really a price issue.